And good morning once again, options traders, and I hope everyone had a fabulous Memorial Day weekend, at least under the circumstances. But it does look like we're starting to slowly move out of this pandemic, and so that's what matters most. But I thought this would be a good time to revisit a strategy that I've talked about earlier, and I can't believe it was actually back in 2018 that I first talked about the box spread in general as a strategy. And the box spread by itself really behaves like a treasury bill. It's a way of lending money to the market or borrowing money from the market. And unfortunately, a lot of times traders look at the box spread and they go, who wants to use T-bills in this market, or in any market for that matter? And that's really the wrong way to look at it, because there's a lot of power behind the box spread. We can look at it from a lot of different angles. I can look at it as vertical spreads. I can look at it as synthetic long and synthetic short positions and different combinations of these. And so what professional traders do is that they can use the box spread to perhaps check various pricing discrepancies in the market, or even better, as a way to leg in and out of the box spread for some very interesting morphs. So let me give you some examples. So here's a very simple layout of what a broker's platform would look like. We've got long calls and short calls on the left. We've got our long puts and short puts on the right. And here's the various strikes down the center. Let's say that we buy a long $100 call. So I've got long one up under the plus column, and then I sell a 105 call. So I've got short one under the minus column. So that's a vertical spread by itself. That's a long vertical. I could come over here to the put side. I could buy a long 105 put, and I could sell the 100 put. That's also a long vertical spread. It's a bear spread. But that's two ways I could look at it. I can look at these as vertical spreads, but I could also look at this horizontally. Up here on top, if I look at just the 100 strikes, that is a synthetic long stock position. I'm long the 100 call, short the 100 put, behaves just like shares of stock. And then at the 105 strike, I have a synthetic short position. Now, if these don't make sense to you, I do have another video in here about synthetics that will explain these. But a synthetic just means that it looks, acts, feels, behaves like a different position, even though it's constructed out of other assets. And so that's what we're doing here. If I'm long the 105 put and short the 105 call, it behaves like a short stock position. So think about it. If I am long shares of stock up here at 100, and I'm also short shares of stock at 105, I'm effectively out. I've purchased at 100 and sold at 105. That's $5 in my pocket. And so that's the way that the box spread would behave. This would be worth $5 at expiration. And that means today we're going to pay a little bit less than that. So depending on how long it is until expiration or what the interest rates are, maybe we spend $4.50 on it, and then it will mature to $5. So again, it behaves like a T-bill. So it's called a box spread because if we take these individual trades here and connect them, kind of get a box. Maybe not the most creative name for it, but that's where the name comes from. So that's the basics of the box spread. Now again, too many times traders look at this and they assume that it's meant to be put on as a box spread and taken off as a box spread. And that's certainly one way you could use it. But the power comes in using the individual pieces. So for example, let's say that we buy the $100 call and we sell the 105 call. This is a vertical spread. It's a bull spread. And so my risk graph is going to look like this. Notice we get our bends at the strike, which I've talked about many times. That will always be true for your profit and loss diagrams. So I've got limited losses over here on the left if the stock price falls, and I've got limited gains if it rises. Okay, well maybe that's how I initiated the position, but maybe things have changed where my opinion has now changed. I'm no longer bullish. What could I do? Well, rather than exiting, maybe I could try to complete a box spread. Let's come down here and buy the 105 put. So remember, this was my initial position over here on the left, and so now I've added a 105 put. And I have a synthetic short stock position here at 105, but I'm also long the $100 call, and that's going to behave just like a long put. So that means that I have changed or morphed my position from this blue line to the red. But the beautiful thing is, notice that I have a guaranteed gain right here. I can't lose. I'm taking a shot that the market's going to change directions. Perhaps it's from my candlestick formations. We're getting a bull kicker off of a 50-day moving average at the top, or maybe we're getting a hammer at a top. There's something that's signaling that this is about to turn. So maybe I do this, I can lock in a gain, but now take a shot for bigger and actually unlimited profits to the downside. Did I give something up? Well, yeah, so far I have, because I had to pay money for that put. So my maximum gain isn't going to be as high here. But I haven't completed the box yet. So what I might do at a later time is come up here and sell the $100 put, and I've now legged into this bear spread and actually completed the box spread. So what have I done now? Now this means I have morphed or changed from the blue spread to the red and now to the green. Now it's very obvious why it's called a box spread, or why it behaves like a T-bill. You can see there's no risk. It doesn't matter whether the stock moves up or down or by how much. I've locked in a gain because I've completed the box. But I've done it at various stages depending on what I thought might happen, or various hedges I was trying to put on. But what if we were lucky enough to have the stock price actually fall? Remember, that was our premise when we went to this red line here, to the synthetic long put. And what if we were able to sell that $100 put and complete the box for a higher price? Well, now my green line might be shifted from here to here. And I might actually end up with more potential profit than I could have had from the vertical spread to begin with. But it was all because I was able to maneuver in and out of the box spread that gave me the power. So the main thing I want everybody to understand is, when you hear strategies like this, don't look at them as just individual strategies in and of themselves. If you understand how to break them apart synthetically, that's where the power lies, because you can now maneuver in and out depending on what's happening in the markets and depending on what's happening with your outlook. And so that is one of the big powers of the box spread. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.